Hi, this is Tim Yoder with Fit Small Business, and today I'm going to talk to you about the benefits of extending credit to your customers. So in talking about extending credit to customers, we're really talking one of two scenarios. The simplest would be you're just allowing them to pay their invoice at a later time. So you're sending them an invoice with, say, a net 30 payment term, meaning they have 30 days to pay the invoice before you'll charge any interest or late fees. So that's one way of extending credit. Another way of extending credit would be actually providing customers with a line of credit. So they can charge so much per month, they can make minimum payments, they can pay it off whatever they choose to do. So you could do some sort of line of credit. But most businesses, it's just going to be extending credit in the form of payment terms, giving them so many days to pay their outstanding invoices. So let's talk about some of the pros and cons of extending credit. So obviously the first pro is going to be increased sales. If extending credit to your customers won't increase your sales, then there's really no point in doing it. The second pro is it's going to give you a competitive edge. So all else being equal, if you can provide your customers with better payment terms, with more credit, giving them more flexibility in how they pay you, that's going to give you a competitive edge over your competitors. And the third is customer convenience and loyalty. And this is extremely important in some industries. If you're in an industry where you primarily cater to other businesses, you really need to consider extending them credit. It's very hard for some businesses to pay immediately. If they send, perhaps it's a repair company of some sort, if they send service people into your location to pick up some supplies, it might be very hard for them to pay immediately. They really need to have credit with your company. And so customer convenience is extremely important, varies a lot by industry, and by meeting that customer convenience need, you're going to produce loyalty from that customer over an extended period of time. Now, some of the cons, obviously delayed payment, right? Cash now is better than cash tomorrow, so we are having to delay the payment, and we need to make sure that our cash flow is going to be able to handle that delayed payment. There's a risk of default, right? Anytime you provide something to your customer without them paying, there's always the risk that they're not going to be able to pay you. And third, you're going to have to spend some effort to collect unpaid invoices. So hopefully many of your customers pay on time. Unfortunately, some of them will not. And you're going to have to spend time and money chasing down those invoices. So some factors to consider when you are extending credit. Again, going back to what your competitors are doing, industry norms are extremely important here. If you're in an industry where all your competitors are granting access, giving payment terms that allow payments within 30 days, you really need to do the same. Again, payment terms provide a competitive advantage. If you're not doing at least the industry norm, then that's a serious disadvantage to your company. And these things are going to vary greatly by industry. Restaurants and bars, they don't extend their credit, they don't extend their customers credits, right? That's kind of a pay-as-you-go business, whereas building material suppliers almost always provide some sort of credit to the builders that purchase from them. So find out what your industry norms are. That is extremely important. Second is realize that you can customize the payment terms for each customer. So you don't necessarily have to give every customer the same amount of credit or the same payment terms. However, I would be very careful about this. I would have written criteria that you follow in awarding somebody credit or the lack thereof, or determining their payment terms. You can't just simply give preferred payments to this customer because I like them. That is just begging for a discrimination lawsuit. So I would highly recommend that you document your credit policy and the criteria to receive credit and special payment terms. Okay, and speaking of the credit policy, it should be in writing, and a few things you should include in your credit policy: your contact information so that they can make no claim that they didn't know how to get a hold of you. Provide that in the credit policy. What their payment terms are going to be, if they have special payment terms, what criteria did they meet to get the special payment terms. What are acceptable forms of payments: checks, credit cards, ACH transfers, etc. A remit to address, so make it very clear where they need to send their payment so they can't claim they didn't know where to send it. Interest and penalties for late payments, so make them aware of what's going to happen if they don't pay on time. When you will consider a payment to be delinquent and possibly be turned over to a collective agency, and also the entire collection process. So at what point are things turned over to a collection agency, and what should they expect? Okay, and the last thing you need to consider when extending credit is the effect on cash flow. Again, this is very important. If your competitors are providing extended payment terms, you really need to be able to do the same, but that is going to have a negative effect on your cash flow, and you need to consider how you're going to deal with that negative effect. So one way to deal with it is through invoice factoring. So an invoice factoring company, they'll basically purchase your accounts receivable. Oftentimes they'll give you an advance of up to 90% of the balance. The costs vary by provider, but generally it's 1% to 4% of the uncollected advance per 30 days. So that's a 30-day rate. So you take that times 12, you're looking at an APR of 12% to 48%. So it's not cheap. Invoice factoring is not cheap, but then again, having all of your working capital tied up in your accounts receivable where you're not able to use it to pay suppliers, etc., that's very expensive as well. So if you're forced to extend credit because your competitors are and you can't deal with the lag in cash flow, then you should consider invoice factoring. Now, don't get invoice factoring confused with selling receivables to a collection agency. Invoice factoring is not the same. Invoice factoring, as soon as you incur a receivable, you can sell it to them. They collect it. It's not a collection agency. It's an invoice factoring company. So it is a separate thing. So what's next? Well, if you want to extend credit to your customers by giving them favorable payment terms, QuickBooks Online has a fantastic invoicing feature. You can set up different payment terms by customers. You can give them early payment discounts in addition to extending them whatever period of time you would like for them to pay you. So if you'd like to give QuickBooks Online a try, you can get a 30-day free trial or 50% off for 3 months by clicking the link in the YouTube description. And finally, Fit Small Business has a lot of helpful information for extending credit to customers. So I've included some links in the YouTube description to some of our articles. We have an article on extending credit, one on writing collection letters, one on writing payment email reminders, and then finally there's a link to our buyer's guide for the best invoice factoring companies if you're interested in invoice factoring. So again, my name was Tim Yoder with Fit Small Business, and I hope this discussion of extending credit to your customers was useful.